How big players trap retail traders in the stock market. Avoid these mistakes. In the stock market, big players, such as institutional investors, hedge funds, or large traders, may sometimes engage in practices that can trap retail investors. This typically happens due to information asymmetry, market manipulation, or psychological tactics, and to gain liquidity and maximize their profits. Here's why and how they do it. Why big players trap retail traders. 1. Pump and dump schemes. How it works. Big players buy a large amount of a low-volume stock, artificially inflating its price, pump. Retail investors, seeing the price rise, may buy in, hoping to profit. Once the price is high enough, the big players sell their shares, dump, causing the price to crash and leaving retail investors with losses. Why it works. Retail investors often lack the resources to analyze the stock's fundamentals and may rely on price movements or social media hype. 2. Stop-loss hunting. How it works. Big players may intentionally push the price of a stock to a level where many retail investors have placed stop-loss orders. Once these orders are triggered, the price may reverse direction, benefiting the big players who anticipated the move. Why it works. Retail investors often use stop-loss orders to limit losses, but these can be exploited by those with the capital to move prices temporarily. 3. Spreading misinformation. How it works. Big players or their affiliates may spread false or misleading information about a stock, for example through social media, news outlets, or forums, to create hype or fear. Retail investors may act on this misinformation, while the big players take advantage of the resulting price movement. Fake news market sentiment. Manipulation. They spread positive or negative news to influence retail traders' emotions, then take opposite positions. Why it works. Retail investors often lack access to reliable information or the ability to verify claims. 4. Front-running. How it works. Big players with advanced knowledge of upcoming large trades, for example from institutional investors, may buy or sell ahead of those trades to profit from the resulting price movement. Retail investors, unaware of the impending trade, may end up on the wrong side of the move. 𝐁𝐢𝐠. Why it works. Big players often have better access to market data and connections. 5. Creating false breakouts. How it works. Big players may push the price of a stock above a key resistance level or below a support level to create the illusion of a breakout. Retail investors may buy or sell in response, only for the price to reverse direction shortly after. Why it works. Retail investors often rely on technical analysis and may misinterpret these false signals. 6. Exploiting behavioral biases, market psychology, exploitation. How it works. Big players may exploit common psychological biases such as herd mentality, fear of missing out, FOMO, or overconfidence to manipulate retail investors into making poor decisions. Institutions manipulate price movements to trigger panic selling or FOMO buying. Why it works. Retail investors are often less disciplined and more emotional in their trading. Retail traders often trade based on emotions, fear, and greed. 7. Dark pools and off-exchange trading. How it works. Big players may execute large trades in dark pools or off-exchange venues, hiding their intentions from the broader market. This can lead to sudden price movements that catch retail investors off guard. Why it works. Retail investors typically lack visibility into these private trading venues. 8. Liquidity needs. Big players trade large volumes, and for that, they need enough counter orders. By trapping retail traders, they ensure liquidity to enter or exit positions. 9. Smart money versus dumb money. Institutions have more data, advanced algorithms, and insider knowledge, while retail traders often rely on technical patterns and news, making them easier to manipulate. 10. Options expiry, manipulation. They move stock prices near option expiry dates to make retail traders' options expire worthless while benefiting from their own positions. 11. volume order book tricks. They use hidden orders, iceberg orders, and spoofing, placing fake buy-sell orders to mislead retail traders about supply and demand. How retail investors can protect themselves. Do your own research, DYOR. Avoid relying solely on tips, rumors, or social media hype. Understand market mechanics. Learn how stop-loss orders, liquidity, and trading volumes can be exploited. Avoid overtrading. Stick to a disciplined strategy and avoid emotional decisions. Be skeptical of hype. Question the motives behind sudden price movements or news. Diversify your portfolio. Reduce risk by not putting all your capital into a single stock or sector. Avoid chasing sudden price spikes or breakouts without confirmation. Use wider stop losses or mental stops to avoid getting hunted. Pay attention to unusual volume spikes and institutional activity. Don't blindly follow news, check price action and smart money flow. Focus on risk management instead of trying to predict every move. In summary, big players can trap retail investors through a combination of market manipulation, information asymmetry, and psychological tactics. Retail investors can protect themselves by staying informed, being cautious, and avoiding impulsive decisions. There are more videos and playlists if you would like to deeper dive into any points. Please check it out.